Whenever you hear someone talking about, democratizing anything and, offering it to the little guy, that really has got to put your radar up, right? That what's really going on is somebody's looking for suckers to make money off of. And I think, 99% of the time that's actually the case.
Hello and welcome to Milk Road Macro, the podcast that knows that leverage trading is a powerful tool if you're trained to use it. If not, it can be a powerful way to hurt yourself. I'm your host, John Gillen. Today is Wednesday, October 15th, and today we are joined by Benn Eifert. Ben is the managing partner and founder of QVR Advisors, where he oversees the firm's multi-strategy business focused on quantitative volatility and options trading. Ben holds a PhD in economics from UC Berkeley, where he also taught financial engineering, and was previously the head of quantitative research and a derivatives trader at Wells Fargo. Ben is going to teach us a lot about the world of financial derivatives, so if that sounds good to you, make sure you like and subscribe. Share this episode with someone who's going to enjoy it. And as a reminder, our Milk Road Macro Pro team serves up a lot of great content and alpha on macro. Every month we drop a pro report that breaks down what's going on, what's moving the markets. The last report was packed with over 50 different charts, all about what it means to be running it hot. So if you want to get in on the alpha, join our pro community today. Full report is available on our site, and the link is below in the show notes. And without further ado, welcome to Milk Road Macro. Ben, how are you, sir?
Hey, thanks, John. I'm really glad to be here. This is going to be fun.
Okay, well, I'm really happy to have you on the show. I think this is great timing. We've seen a lot of cascading liquidations in the crypto markets, and so I want to kind of get your thoughts on some of those things. But before we get there, I thought we would start kind of at a high level. What is a volatility-focused derivatives trading fund, and what does that do? What does it involve, and what value is that bringing to investors?
Sure. I mean, I'll speak for us. I think probably every volatility and derivatives manager has a little bit different take. But I think the pure idea of volatility trading is that it's not focused on the direction of underlying assets, but rather on what you would call higher order moments of the distribution. In other words, the volatility, the tendency of an underlying to move around, or things like skew, how much more assets move around to the downside than the upside, or in crypto often vice versa. Things like this, so that are all kind of always neutral to the direction of price, which is a little bit unusual because most other strategies in the world you would think of as one way or another, kind of buying an asset and hoping it goes up, or shorting an asset and hoping it goes down, or some combination of those things. And so in volatility trading, we do that, but with volatility rather. And then in our case, I think the important concept is everything really has to do with the nature of dislocations in derivatives markets that emerge from flows and transactions that aren't really done by arbitrage market participants that really know how to think about price, but really they're done by end users of derivatives, big pension funds or retail investors that are just doing stuff in derivatives markets without thinking about it. And those markets need participants that can understand relative price and understand relative value and kind of warehouse risk in a market neutral, intelligent kind of way, and that's kind of long tail. So that's really what we do.
Gotcha. Okay, so you're not so much focused on whether something's going to go up or down, but around different kinds of market behavior and trying to capitalize on that. I think that there's a huge galaxy of things that fall under the category of financial derivatives, and I know you taught financial engineering, but just so our audience has an understanding of some of the basics around these things, could you explain some of the difference between like what a futures contract is, what options trading is, and some of the different ways that investors might want to use these products?
Sure. So a futures contract is one of the simplest derivatives and one of the oldest derivatives. You could think of, corn futures that farmers use to, hedge their price impact, right? So a future is just a linear contract that, gives you effectively exposure to the price of something in the future. Traditional futures have a fixed maturity date. So here we are in October, it might be a December futures contract on corn. You buy it. And effectively, it's just like owning corn, except for you don't have to physically own the corn. Somebody else is going to deliver it to you in December. Crypto kind of created this innovation of perpetual futures, which don't have a maturity date, but rather have kind of a funding charge that gets paid between longs and shorts every day based on supply and demand. That's a really neat innovation. We might talk about that a little bit later. So these are very simple structures. The sort of the next level of complexity in derivatives you would think of as options, which a lot of people might be familiar with options because of, for example, like employee stock options that someone would get. But an option just gives you the right, but not the obligation to buy or sell a security in the future at a predetermined price. And so that doesn't give you a linear exposure to the underlying. So, for example, say Bitcoin's at 100,000, you could buy a strike price 110,000 Bitcoin call for for December, that if Bitcoin went up above 120,000, you could maybe you could buy that call for $1,000 or something. And so if Bitcoin went to 130,000 by the maturity date, you can buy it at 120,000 for just having paid that 1,000. You're going to make 10 times your money, right? So that gives you a very asymmetric return profile, as opposed to kind of the linear return profile of a future. So options are very flexible instruments that you can use to achieve a lot of different objectives you might have.
Gotcha. So traditionally, these contracts were usually between larger institutions, and they were used they were used in a number of different ways. But recently, there's been a much broader adoption of these, and in a lot of different interesting ways. There's been some regulatory changes that have allowed that, but a lot of this has moved on to exchanges. And retail traders have gotten heavily involved in this market, particularly in options trading. As of this month, zero-day options trading account for somewhere between 50 to 60% of total S&P 500 options volume, which is up from less than 5% back in 2016. So there's been a huge upsurge in the amount of, like financial derivatives products that retail is trading. How did options trading and derivatives products become so popular with retail investors? What's drawn them to this particular product?
Yep. So this has been really a huge change in markets that started, I think, really in earnest around 2019, although some of the roots of it came earlier than that. You really have had a broad-based big upsurge in the interest of retail investors more generally in kind of aggressive trading across a lot of different kinds of products. In 2019, we sort of had the first meme stock, which was Tesla. Attracted a ton of attention, a lot of narrative around Tesla, a big kind of fan club around the company. You saw retail traders showing up on Twitter with like Tesla in their handles, talking about Tesla all the time, and creating this big momentum surge in Tesla. And that started involving options as well as just stock ownership, in part because options, buying call options, kind of gives you more leverage than just buying, fully funded, buying the underlying. And then that started to metastasize, and then we hit 2020, we hit the kind of global pandemic. And one side effect of the global pandemic, I think, was really accelerating this megatrend, right? Where you all of a sudden you had a lot of people who were stuck at home. Their bosses weren't walking around looking over their shoulder, and they could have their laptop up alongside them working remotely, and they could be day trading, they could be getting into investing. And there was the spread of a lot of kind of social aspects of trading, right? More and more, people getting into discords and getting into group chats, and it becoming kind of a group thing, right? And then the growth of brokerages like Robinhood that really targeted these kind of people and gave them, I mean, in Robinhood's case, very kind of gamified trading experience with like confetti blasting across the screen when you lift the offer on an option and all this kind of stuff, right? And so it really just kind of was this freight train of a social dynamic that grew and grew, right? It wasn't just like in the old-fashioned investing anymore. It was kind of this fun, it started to resembling much more like sports gambling in a sense, right? Or this kind of thing where part of it was really entertainment. And I think it's and then you hit the meme stock boom in 2021 with GME and everything. Obviously, we all remember all this stuff, and it's just kind of snowballed ever since.
Gotcha. So this has been, like you said, a relatively new phenomenon, but it has really gotten a lot of adoption and traction. I have a lot of questions about this, but I think the first thing I'd like to know is like, how has this changed the derivatives market in your mind? From your professional quantitative volatility fund, how has this changed the derivatives market? Has this been a boon? Has there been drawbacks? What are the changes that this huge retail adoption craze has brought to that market?
Yeah, very much so. I mean, it has certainly been a catalyst for a huge increase in volumes, which inevitably is very good for different kinds of derivatives market participants. So for market makers, for example, obviously it's highly profitable because market makers, they make their money on the bid-ask spread and and on volume, and the more transactions are happening in the market, the better. People like us make our money on derivatives market dislocations, and we love, obviously, the higher volumes are, the more things are moving around, the more interesting trades set up for us, and also the better liquidity that we have when we trade in the markets. And so we can get 10 times bigger positions at better prices, leading into bigger dislocations. And so that's all really beneficial for us. It's certainly created a market in which liquidity is a lot better, volumes are much higher. There are certainly crazy market dynamics that emerge from it. Things like GME, which you really hadn't seen before in the same way. We've certainly seen short squeezes before in the market. That's a thing, but this dynamic was really unusual in how you have to think about it, and obviously how you have to risk manage it. If you're a hedge fund, long short equity hedge fund, you could think of Melvin Capital, where they were a bit perhaps overly arrogant about their short positions in GME, and the GME retail crowd really just ran them over and blew them up in a very spectacular way, right? So obviously, as a hedge fund, you have to think about that that potential dynamic when you're putting on positions.
Gotcha. Yeah. Okay. So there is obviously there's been a lot of changes in this dynamic, but one of them that stands out the most to me is sort of what you described of like the prior way that people used to use financial derivatives like futures contracts was to sort of like hedge out some uncertainty in long-term operations, industrial activity. And then what we've seen with some retail adoption in recent years is much more like entertainment, like gambling. Can you tell me a little bit about your thoughts on this? Is Wall Street, by making these things more available to retail, are they democratizing access to finance, or are they really like setting up retail to just be exploited and taken advantage of? Like, where's the balance between this in your mind?
Yeah, so I have pretty strong views on this, and it's all a continuum to some extent. But I do think that a lot of the narrative, whenever you hear someone talking about democratizing anything and offering it to the little guy, that really has got to put your radar up, right? That what's really going on is somebody's looking for suckers to make money off of, and I think 99% of the time that's actually the case. I do have really, I think my view on this is, look, probably the best thing that your average individual investor can do to benefit from markets over the long term is to buy and hold equity index, maybe some Bitcoin, who knows, depending on your views, a diversified portfolio, and sort of not mess with it too much. And that's likely to have pretty good outcomes over a long period of time, and be very low cost, and there's very good products for that. Generally, there's a ton of evidence across the whole world and across all asset classes that the more aggressive day trading like behavior that you see among retail traders, like the worse they tend to do. They tend to lose a lot of money. That's obviously why brokerages make money. And you really have to be careful about this. Now, that doesn't mean it doesn't suit any one individual. It's not every case is different, right? But I think that's certainly the evidence on average. And so for me, I guess how I think of it is, look, a lot of the big boom in trading and across crypto, across TradFi, and is kind of fun. It's gamified, it's social, it's entertainment, and that's kind of okay in a sense, as long as people as long as that's a shared understanding, right? It's kind of like going to Las Vegas and playing blackjack tables. I love Las Vegas. It's a lot of fun. I kind of have my budget of like what I'm willing to lose, and like everybody's having a good time, and you're like having a martini, and like that's great as long as like we all agree that's what it is. Nobody in Las Vegas is telling you this is like a very likely way to get rich and make generational wealth for your children, right? But Vlad Tenev at Robinhood is kind of trying to tell people that, right? And say, look, we've made option markets accessible to the retail investor. You're going to sort of make a ton of money. This is great. We're democratizing this. You can be just like the hedge funds. And like, that's a terrible narrative, right? Because by the way, like options are very complicated, and the technology and systems and information and skills and institutional knowledge you have to make money intelligently over time in derivatives markets is very, very high bar. And it, like retail, is bringing sort of like a floppy herring to like a nuclear war, and Vlad is just sort of serving people up on a silver platter to that. So I think it really depends on what you're talking about. In general, the narrative of democratization of finance and financial tools and stuff, I think is more predatory than not.
Yeah, and I think that there's an awareness of that, but maybe not enough. But I don't think it's necessarily. I know you don't intend this, but I don't want to like try to single out Robinhood for this by any means, right? I think that this has become pretty widespread. Something that, no, absolutely. But this is sort of my concern, and one of the things I want to talk about. You talked about perpetual futures contracts. This has been something that has been created in the crypto industry, which again has been very retail focused, retail led as an industry since its beginning. I would just explain to our audience a little bit about what a perpetual futures contract is. These have gotten really popular with retail, and many people are now saying that this might start coming to the equities markets, to ETF markets. Just tell our audience a little bit about what these are, why they were created, and where you sort of see these going, and what your thoughts are on this.
Yeah, absolutely. Perpetual futures are, I think, one of the most interesting kind of technological innovations to come out of the crypto space from a TradFi perspective. So first, let's just start with what a regular futures contract is. So, and we talked about this a little bit, but again, the futures contract just basically if I buy a corn future from you, it means that you agree to sell me, a certain number of bushels of corn in the future on some particular date. So call it, December 15th. Today's October 15th. So in 2 months. And then, I'm going to pay you for that. And then, of course, in the future, the price of corn might be different than it is today, right? And so you have some kind of linear exposure to the price of corn. Now, if you want to just own corn via futures for a long period of time, because there are those maturity dates, it means when I hit that December maturity, I need to do what's called rolling my futures from December into, say, March, which means I have to sell my December contracts, buy March contracts, pay some transaction costs. There might be some arbitrageurs who know that I'm going to have to do that and who are going to front run me. And so it's generally expensive to have to do that mechanically. So perpetual futures are this neat innovation that came from crypto, where there isn't actually a maturity date on the futures contract. Within what there is effectively a supply and demand driven mechanism that creates an instantaneous funding rate, where if I want to buy those corn contracts and somebody else wants to sell those corn contracts, we end up meeting on the exchange. There's a certain kind of balance between supply and demand at a particular point in time that drives what that funding rate is. And intradaily, maybe every hour or every multiple times a day, the longs might be paying the shorts a certain instantaneous financing spread, or vice versa if the demand's on the other side. So you don't have to roll contracts in a particular month. Like, this is it's a really nice kind of structure, actually, that TradFi didn't come up with at all. But exactly as you alluded to, so these are already these grew up in crypto, but they're already being brought into equity markets. And so you think of Hyperliquid has a big platform that's starting to do this. Actually, one of my really good friends, Maddie Litt, works for Vest Markets. That's a Jane Street-backed exchange that's doing the same thing. Think of starting with equity indices with like the Mag 7 names and the popular momentum names, oil, gold, all this kind of stuff. It's, I think, a really interesting dynamic, and those volumes are already growing really, really fast. Again, people are familiar with the product from crypto. There's a lot of overlap between people trading crypto and people trading, popular technology stocks, for example. And so I think I think honestly, I think that space is just going to blow up. I think that's going to be a hugely successful product. And, my personal view, I mean, I'm an options guy. If you know my Twitter, I think one of my core, simple messages to everybody on Twitter is like, one, stop trying to trade options. This is hard, right? Like, options are really complicated. And that doesn't mean like there aren't use cases for options, right? But like, you really have to educate yourself. You really have to be careful. There's a lot of pitfalls and complexities to options and ways to lose money. People buying call options on GME and GME going up and then losing money because actually implied vol was 700% and this, that, and the other thing. And like, this is complicated, right? Like, a perpetual future is a really easy thing. And it just gives you, a sort of cash efficient way to get linear exposure to a thing, and you don't have to worry about financing. You don't have to worry about convexity and gamma and theta and all this kind of stuff. So I actually think many retail investors would probably be better off, trading something like a perpetual future instead of trying to trade options.
Yeah. So I think that there's a lot of things you bring up here that I want to kind of like highlight to our audience. The first one is not just like the education that is required to use these things, like learning all this different galaxy of Greeks and what they mean and what it implies for your option or your futures contract, but also something you touched on in your prior answer, which I forgot to highlight, but just the amount of backing in terms of other operational support, institutional grade systems, and just the amount of things that goes into being able to effectively leverage these. It does require an institution to do that, and that's one of the reasons why retail is so ill-equipped to operate in these markets or with these products in a financially responsible way. And I think sometimes people underappreciate that just because they have access doesn't mean that they're necessarily equipped or educated to properly use this for their portfolio management. So something I want to ask about here, as far as perps futures go, I agree this is a growing market. It's already about $1 trillion market just in crypto alone. But one of the things that these contracts offer investors is leverage, and in some cases very high leverage. So we talk about Robinhood a little bit. There's a platform called Aster that offers users 1,001x leverage on their accounts. And I've just been very concerned about the growing use of leverage in just retail investor behavior. How does this, so in crypto, the crypto assets are highly volatile already, and the application of leverage increases the risks to a person's, investments in that situation. I'm rambling a little bit, but just tell me a little bit about your thoughts on the use of leverage. How should investors think about this, especially retail investors?
Yeah, absolutely. I mean, leverage is very much a double-edged sword, right? It, on the one hand, in lower volatility periods when markets are trending up, leverage can make you look like a hero. But the problem is leverage can wipe you out, really, really quickly on the downside, right? And it really comes down to, how much risk can you tolerate? How much, how well capitalized is your account? How are you approaching this? I think we talked a little bit, but just this last Friday, we had a big sort of leverage washout in crypto. And part of the issue here is, right, you might use a bunch of leverage and make 10 times more money than you would have otherwise in some kind of big run up. But when you are leveraged, the problem with the downside risk is you can't hold on to the position, right? So there's kind of this notion of, diamond hands, or I'm a true believer in Bitcoin, or whatever it is, right? And you're like, I'm just not going to sell, and so I can ride through the volatility. And if you own an unleveraged position in Bitcoin, nobody can ever force you out of it, right? But if you're running a 50x leveraged Bitcoin position, obviously the whole point is, relatively small move, you can get entirely wiped out, and it doesn't matter how much you didn't want to sell. Like, by the way, you made the decision to that you would be forced to sell by applying that much risk, right? And that's really the danger. And I think people really have to find the right balance there. It's one thing to say, look, I'm willing to tolerate a lot of risk, but you really have to kind of do some sensible modeling and stress testing and checking around your position. And are you going to be able to hold your position through, a period of increased volatility? And, in a lot of cases, the answer is no, with the amounts of leverage that, people will apply.
So this specific incident that you referenced that happened last Friday, this has really spooked a lot of people and really damaged the crypto markets a lot. It didn't spill over into the larger equities market. You talked about low liquidity environments. A lot of this happened, after the close, after hours on Friday. So the equities markets were closed, but crypto trades 24/7. We spoke a little bit about how the innovation that's come out of this and the progression of financial derivatives has led to perpetual futures, which is something that TradFi never really thought of, but is now starting to adopt. Do you think that there's a risk of something similar to this happening once these perpetual futures contracts start to come into the equities market and get more broadly adopted by the TradFi system?
It's certainly possible. TradFi itself obviously has found ways to have ridiculously high levels of leverage that have caused problems in other ways. We don't need perpetual futures for that. I think they're just sort of like another trick in the bag. But I think it depends. It's interesting. Like, when you think of, there were various attempts to list single name equity futures in the past that didn't really take off. But I think part of that maybe was just a lot of those efforts were at a time where there wasn't as much retail interest in kind of trading and in leverage and all these sorts of things. I think it's likely to, take off much more so now. So yeah, I think there absolutely are risks. I think it comes down to a combination of, education for investors and traders about like how to take an appropriate amount of risk and to risk manage more carefully, potentially to, regulation around these kind of things. Generally, I generally am a skeptic of regulation where it just comes down to, letting people do what they want with their money. But I do think ultimately the part of the issue with leverage is it can kind of cause these cascading waterfall effects and sort of negative externalities, right? And in the limit, obviously, if that leverage is concentrated like in the banking system, it can be a big problem, right? Because you have these, huge impacts on lending and everything. Generally, if it's just leverage exposure for individual traders, it's, doesn't have as much spillover effects, but you do have to be careful about these things. So yeah, I would not rule out that there's some risks associated with this. But that said, right now retail investors are getting a lot of leverage by doing things like selling zero DT options on single names and stuff, which is even scarier. So I think it's all to some extent again kind of comes back to people are very, very interested in this casino, which is, aggressive trading. They're already doing lots of dangerous things using lots of very complicated instruments that they don't understand. I think my view on the perpetual futures stuff is that given that context, they're actually kind of simpler and safer than some of the things that are doing now. The things that are doing now, that doesn't mean they couldn't be abused. But I think that's kind of where the balance lies.
Gotcha. Yeah, I appreciate the nuance on that. So a question that I had and something I've been thinking about, I don't really know how I feel about this, so I wanted to hear what you think. In equities markets, they have the concept of a circuit breaker to shut down the markets if things start to get wild and you've kind of blown out the bids and the asks. And the value of this is it stops the market for a bit and allows the bids and the asks to catch up, and then they can sort of restart trading, and it kind of helps prevent some of these like highly volatile, low liquidity environment crashes, flash crashes like we saw on Friday in crypto. Do you think that there's an opportunity to bring something similar to that into crypto? Do you think that would be like even viable at all in something like a hyperliquid, or is is there that like not practically possible to do in that asset class?
Yeah. I think there's a couple dimensions to that. I think there's likely some subtle kind of technical aspects to that question that I don't know the answer to, and that there are other people would be better to opine on. But I think just conceptually, it would make a lot of sense, right? Because part of the issue with these cascading liquidations in crypto, right, are that protocols have very aggressive, liquidation mechanisms in order to protect themselves, and you get large positions being sold and liquidated at really terrible prices and low liquidity, pushing things down and creating kind of a cascading waterfall, right? Nobody has time to recapitalize their positions. If you had circuit breakers, part of what a circuit breaker does, right, is it just puts a hold on this market for whatever it is, 15 minutes or something like that. It gives liquidity bids and offers a chance to get reestablished. In principle, it gives people time to get to push more money into their accounts to support their positions if they want, all these sorts of things, and just creates a little bit more order to the system. So I think from a conceptual and practical perspective, it makes a ton of sense. There may be some technical aspects that I'm not aware of in terms of how you would need to manage this, on chain and everything. But I think it would be really interesting to take a look at.
Yeah, I would like to see some more attention given to that, and then just having exchanges have more insurance funds, because a lot of like TradFi exchanges use that as well to kind of like secure themselves and their users. So there's I think a lot more to explore there. We talked a little bit about retail investors being educated and equipped enough to properly leverage these products and engage in these markets. I'd like to hear your thoughts on those, but first the education piece. Like, how do you think we as a society, really, I guess, or as an industry, need to go about this problem of educating retail investors about these things? Is this something that falls on government, on regulators? Is it something that falls on like product providers, exchanges? Where does that happen in your mind? What's that look like to you?
Yeah, no, that's a great question. I mean, so it, there are when you look at educational efforts in the space by the product providers, for example. I mean, it would really be ideal, right, if brokerages and exchanges were producing a lot of good educational content, and they do produce a lot of content, and some of it is okay, but the problem here really is incentives, right? So brokerages and exchanges make money on volume, right? And in some cases, brokerages, when you think about actually the way the economics works, I mean, most brokerages these days are going to generate most of the revenue from payment for order flow, right? So they're partnering with market makers like Citadel Securities and Jane Street, and they are getting paid a certain percentage of the spread kind of back in exchange for that. And what that means is they're not only incentivized to generate the most volume possible, they're also actually incentivized to generate the volume that of a type that is most profitable to the market makers, right? And so does that mean like they're going to go and educate people in the best possible way from like a fiduciary perspective, like let's really help these people know what they're doing? Or does it mean they're going to encourage these people to do just ridiculous stupid shit? And it turns out it's the latter, and that's just like a basic function of how brokers work. And this is not new, right? This is not a Robin Hood thing. This is like goes all like watch Wolf of Wall Street. Like it's literally the same thing, right? It's like from the beginning of time, all these guys want to get you to do is trade as much as you can and lose as much money as you can, and that's how they get paid, right? So you're not going to get good educational content about this. I think some people do an okay job. You think of Tasty Trade actually provides a lot of educational content on options, and some of it is good, like just teaching people what the structures are, how they work. But at the end of the day, they are really encouraging you to do like all these 4x4 crazy weird option spreads that you roll every 2 weeks and stuff, because that generates the most commissions, right? And so ultimately, I think you have to look beyond that. It would be great for government to do education, but just government is rarely. And I'm a pretty kind of left wing guy. I sort of believe in government, but it's just hard for like government to do a good job of doing like options education, right? It's just like so far out of the core competency of what governments are ever good at. So I don't really know the answer. Honestly, the main things that I do on Twitter are things like education. Although I would say I'm probably most of what I do is, well, I mean, I suppose there's a combination, but I really do try to do some basic educational stuff and try to point out the pitfalls of a lot of what that marketing content is, where people are telling retail investors misleading stories about how they should be trading, what they should be doing. And I try to kind of be out there with content that says, no, like, listen to this, like these guys are coming after you. Here's what you need to think about. So, I think ultimately it kind of is on, people in the space who, are professionals and can be helpful and want to give back, to some extent, to try to, even if it's not in our direct interest. Like, I mean, that's one of my things, people will ask, well, why the hell are you, don't you want people doing crazy things and creating dislocations? Don't you make more money? And the answer is yes. But like, look, I don't, that's not the way that I want to be making money. Like I want to take money from Goldman Sachs. I don't want to take money from, retail investors doing stupid things. And that's just sort of who I am.
Yeah, I think that's a very balanced view of this, and I think it's something that I'm struggling with as well. Is that I think we've in prior generations we had a struggle of converting people who were savers into investors, and now it seems like we're struggling to turn what are effectively gamblers into investors, and it's
Yes.
a different kind of education. I'm not sure how to skin that cat either. I think something I've been thinking about as well that I'd like to get your thoughts on. There's this notion of an accredited investor in our
Yeah.
society, and it's somewhat of a barrier around access to certain financial markets. Do you think that there's a version of that? But like people have railed against that as well, saying that that's limiting access and so forth. So how do you think about like barriers around some of these products or some things that might be helpful to protect investors versus what is actually just like precluding them from markets? Like, what is your thoughts on that spectrum there?
Yeah, again, I think it's a kind of a subtle and tricky issue where, on the one hand, if you're not an accredited investor, there's restrictions on what kind of private investments you can make, for example. But the trick is, when you look at who is the loudest about getting rid of accredited investor protections, they are people who want to dump really low quality bags on retail, right? And it's 100% every time. It's all about sort of democratizing. But what do they want to do? They're like private equity firms that want to raise money from retail investors to dump like the companies that they can't IPO for the last 15 years that are why their funds are all illiquid. So I think it's really tricky. Um, ultimately, most people have jobs, they're busy, they're doing stuff, they're not sort of specialists in finance. And I understand the perspective that they would be much better off just kind of like owning some index funds that rebalance and where they don't have to like worry about a lot of these details and not trying to like invest in companies that are doing some kind of scheme to truck soybeans to some place and then sell them on the blockchain or something and like lose all their money. On the other hand, I kind of believe people should be able to do what they want at the end of the day. And like, why are you saying that they can't do this, right? So like for me, I think it's a complicated issue. And I don't know the right answer. I think that I certainly wouldn't say that we have the right regulations and we think about it the right way. I'm sure that we could do a better job all thinking about it together. But I do think it's tricky because I think you drop those regulations and the first thing that happens is everybody's much worse off because retail ends up buying a bunch of really low quality crap that's pushed on them by sharks.
Yeah, and I don't think that either one of us knows what the right solution to this is. But one of my goals with this conversation, Ben, was just to bring on somebody who is a bit more of an expert in this world and to just sort of ask some of these questions because I think having our audience think about these things more deeply for themselves is maybe the first step here. And the most important thing is that if you're an investor in these markets, you have to kind of reflect on these things and figure out what your goals are, what your risk tolerance are, and just think about this for yourself right now because that's the best we got at the moment. So I want to talk about the future of this, right? So, and I do want to say this too, that one thing that really has been amazing that's come out of all of this retail access has been enormous amounts of innovation. We talked about perpetual futures, but we also got decentralized finance, we got stable coins, all these like meme coins have also proven sort of the use case for tokenization of assets. There's a lot of innovation that's come out of this. And without asking you to speak on everything, I'm interested to hear your thoughts on the future of like financial engineering and derivatives products, because I think, like you said, this is a huge and emerging aspect of the market. Where do you see this going from here? What does the next steps look like? And what are you most excited about in terms of innovation here?
Yeah, no, absolutely. I mean, there's, obviously been tons of really interesting things going on in crypto. I mean, we've always thought it's a fascinating space. I think, again, nuanced, there's lots of scammy, fraudy stuff, but there's also some really interesting stuff and some really interesting technology. We are currently kind of starting to get involved, very actively involved in crypto derivatives. Bringing in bringing in a top team and everything. So I think we're super super excited about the space. I mean, I do think perpetual futures are a really interesting direction. I do think that's a really good product. I do think that in derivatives markets, 95% of new products are probably unnecessary and a distraction, and many of those don't work, and some of them do. But on the margin, every once in a while, something really interesting comes along that allows people to manage risk better, transfer risk better. The VIX options and futures, that whole complex is a great example of that. And again, I think also perpetual futures. It's really hard to know where all of this goes, but I think we're just really excited to be involved around the way. I think our world focuses a little bit less on kind of knowing what's going to happen and positioning for it in advance, and more in just getting really good at understanding who the market participants are, what they're doing, seeing how that's impacting price and relative value, and learning how to kind of be one of the people that take advantage of that and sort of restore balance to the markets in a sense.
Gotcha. Yeah. Well, Ben, I really appreciate you sharing a lot of thoughts on these things. I think there's a lot of other questions I could ask on this, but I think the one I want to come back to here is we talked about education, but then the equipment aspect of this, like being equipped to properly engage in these markets. A lot of people, I think, are not. What would you tell a retail investor who has been engaging in these markets, kind of maybe feels like they're getting fleeced a bit, but wants to get aligned with somebody who's more equipped to help them navigate this? How should retail investors go about thinking about that? Where should they start? What would the first steps be on that?
Yeah, so I think there's a couple different aspects to that. The first thing is to be very careful about influencer style people and YouTube course offering people who are telling you what you should be doing in the space and getting paid for that one way or another. These people are generally kind of charlatans taking advantage of you. There's this whole thing about like selling options for passive income that's very predatory. That's all of the narrative around this is very misguided and very misleading. You really have to recognize that you have to really recognize incentives in the space and understanding who's actually trying to help you and who's trying to take money from you, right? So that's the first thing, is where do you get your information. In terms of where you should get information, I wish it was better. So one thing that I do, again, I try to do a decent amount of education, but I also have like some Twitter threads that people have contributed to that have lots of good reading materials, resources, all their favorite content associated with it, that you can just kind of go through all of that and make a list of things to read. I think that kind of thing is a really great start. And then in terms of other resources, learning to think about what brokerages to use and what pluses and minuses there are there. Really learning to think about execution and how you execute in the market is really important, because options aren't like stocks. Stocks have extremely tight bid-ask spreads, and like there's almost nothing you could do to screw up like trading a stock unless it's a micro cap, right? You put in a big sort of market order and it just doesn't really matter that much for the most part. In options is totally different, right? A lot of options have like a non-trivial bid-ask spread, and if you're just going out and lifting offers all the time, like you're actually just paying Ken Griffin a ton of money, and you don't want to be doing that. So learning about like how to put orders in the market and watch them, learning how to even use like interactive brokers and use orders that actually move themselves with the market and things like that is actually really, really important.
Ben, I really appreciate you coming on and sharing this with the audience. I think that you've given people a lot to think about, and some helpful perspective on some things that, nobody, like I said, nobody knows the answers to, but that people need to think deeply about if they want to be an investor in these markets. So thanks for being here. Where can we send people to find more of you and your work online?
Yeah, so you could take a look at my Twitter handle. There you'll find a lot of stuff there. And then we have a website. I run QVR Advisors. Take a look there. You can just Google QVR Advisors, will come up. And there we have a whole kind of content and research page that has a ton of different stuff that you can download and read. So take a look.
Dr. Eifert, thank you so much for being on Milk Road Macro.
Hey, John, this was really fun, man. Thank you for having me.
Absolutely. It's my pleasure. I hope we can have you back again soon. All right. And thank you all for joining us. So look, until next time, please stay safe, stay educated, stay bullish, and we will see you all on the next episode of Milk Road Macro. Thanks for being here, everyone. Bye. Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.